Hi. I hope everyone's enjoying their dinner. I must admit, I've missed the sounds of animated chatter and loud laughter live. Before we begin the keynote speech, we would like to welcome our guests who are joining us virtually on Zoom. Thank you for taking time to join us. Can we put our hands together now and invite James Cheo, Chief Investment Officer, Southeast Asia HSBC Global Private Banking and Wealth, up on the stage for his keynote speech. James?
Oh, thank you, Anita, and thank you, Anurag, earlier for setting the stage for tonight's event. It's really about adapting to disruption. And clearly, I think that's what's happening across the world, as well as in financial markets. And I want to start off with this quote from Charles Darwin, which says, it is not the smartest nor the most intelligent that survives. It's actually the one who's the most adaptable that thrives. And I think there's a lot of wisdom in this saying. And what is clear is that the world is being confronted with a few things. We have the disruption from the pandemic, the disruption from the war, as well as disruption from climate change. And the combination of all these disruptions is creating huge amounts of uncertainties in the financial markets. Clearly, the disruption from the pandemic has caused supply bottlenecks to happen. At the same time, you have had the war that's pushed up commodity prices, and all these pressures fit into inflation, forcing inflation to increase across the world. And as a result of rising inflation, central banks have no choice but to prioritize the fear of higher rates, have to prioritize higher interest rates increase. And because of the tightening of monetary policy, there is fears that the world might even slip into a recession, which we're going to touch about that, whether we will get there or not in a subsequent presentation. But what's clear is that because of the pandemic, the world has become much more indebted. And a lot of this indebtedness is driven by central banks printing much more money through quantitative easing program. And because of this stimulus that's occurred since the pandemic, what we got was a kind of a demand-supply imbalance. The stimulus has pushed up demand in a very significant manner. At the same time, you have supply that's very much constrained. And because of that, we got an inflation problem across the world. And I think it's very important in terms of the inflation outlook, how inflation will be in the next 6 months. And I think the view here is that I'll start off with I have actually the bad news and a good news. And I think I'll start with the bad news first, so that you all can have your dessert in peace. So the bad news is this, I think it's going to get worse from here, at least the next few months. Good news is that it should improve going into 2023. Why do I say that? Because number one of the reasons why we are having an inflation is because of labor shortage. And that's a phenomenon across the world. So what we are seeing now, at least in the United States, is that there is a huge amount of labor going into the labor market again. So about 1.2 million workers have actually entered the workforce this year. And because of the increase in labor supply, what we're going to see is that wages are starting to level off. So that's very important. And of course, another trend that has occurred encouragingly is that commodity prices have started to stall and level off. And I think that should help the inflationary outlook to stabilize in the second half, at least in going into 2023. Our view is that inflation in the next few months is going to go higher, and perhaps we might even have a peaking of inflation in September. But meanwhile, I think the next few reading is going to be tough, and that's going to create quite a bit of uncertainty and uneasiness in financial markets. But one of the trends that's clear is that growth is slowing across the world. Whether it's Singapore or globally, economic growth is actually slowing down. But I don't think we would get a recession this year. Why is that so? Because more importantly, the first half of this year, growth has been quite strong. And you need a shock that's very big to bring the entire world into a recession. There are certain pockets of strength. The US consumers are still spending, despite inflation at 8-9%. Spending is still very strong there, really because employment situation is strong. There's hardly, unemployment rate is very low. Similarly, in Singapore, likewise, consumption is strong with the reopening, unemployment is low, and therefore a big global recession this year is quite unlikely. And of course, you have another factor. China is stimulating its economy While the rest of the world is actually raising interest rates, China is actually cutting interest rates, keeping monetary policy easy. But of course, the real uncertainty is the zero COVID policy in China. That's a big unknown, very hard to answer. About last week, I was in Jakarta, so I met a gentleman. He told me that he has a theory why China is keeping a zero COVID policy. So I asked him, Buck, why do you think so, that China is having a zero COVID policy? And that gentleman gave me his theory. His theory is this: China has a zero COVID policy because they want the lockdown, and the lockdown can create more babies. So in my mind, I was thinking, if you take the Singapore experience with lockdowns, you don't create babies, you create maybe more divorces. So I'm not sure in China's case what's going to happen in the months ahead with these lockdown effects, but we'll see. And it's a joke, it's not meant to be serious in the forecast or anything like that. So as much as the world we face is very uncertain, it also has become much more divided. And clearly, the Russian-Ukraine conflict has introduced uncertainty on multiple levels, and it's very hard to predict with certainty how that would pan out. But I think one clear trend is that it destroyed the peace dividend that we've seen since the Second World War. And what it means is that governments across the world, especially in Europe, will increase spending on security, anything from military to even cybersecurity. And I think that trend will continue on. And of course, for investors, it's also an investment opportunity in the years ahead. And one crucial trend is, of course, digital transformation. It has happened for many years, but of course, the pandemic has accelerated it. And of course, it also makes all of us adapt. I mean, through the pandemic, we've all adapted. How we live, work, and play is totally almost done digitally now. And I think if I recall back, when I started working almost about 2 decades ago, one of my first routine is when I go to the office is to turn on my Bloomberg screen. So I have 4 Bloomberg screens looking at economic data and of course market movements overnight in the US. So when I look at those screens, it will make sense of the world for me for the day, especially in Asia. But that routine kind of changed with 2016, the election of President Donald Trump. Because just looking at the 4 screens alone is not enough. I have to monitor his Twitter, his tweets, because that moved markets as well. So I have to, instead of 4 screens, I have to have another screen on his Twitter account. But then came 2020, election of President Biden. Trump's no longer around. Biden doesn't really move markets with his tweets. I have a new guy. I have to follow Elon Musk. And then I ask, so I have a friend who covers Tesla as an equity analyst. I ask him, because in financial markets, you want to be ahead of things. You want to not just follow Elon Musk. So I asked him, besides Elon Musk, who else should I follow? And you know what my friend told me? He analyzed Tesla. He told me, follow his girlfriend. Then I asked, which girlfriend? Because that's going to be quite confusing. So I think the world has changed a lot. We have to adapt with our strategy, and I think that's going to be very important in our investments. What's clear is that over the last 2.5 years, we have interacted with each other through Zoom. You might have seen me through Zoom webinars, but now it's great to be face-to-face. But as we have Zoom, in more ways than one, Zoom's interaction is very much two-dimensional. That level of interaction is not as great, it's not as engaging as you would like. And I think the evolution of it would be into a kind of a new world of metaverse. Metaverse is where the virtual and the real reality kind of come together. And I think that's going to be the future of work and play. The earliest inklings of how a metaverse looked like will be sort of the gaming metaverse that probably your children are very much involved in. And I think during Chinese New Year, we give out red packets, right? Ang paos during Chinese New Year. So this Chinese New Year, during Chinese New Year, my niece and nephew came to me, and when I gave out the ang paos this year, or red packets, with cash, so they said, I don't want the cash. I want it in Robux. By the way, Robux is the digital currency in the Roblox metaverse. It's part of their games. They use that to transact, buy their avatars, change their clothes, buy homes there. So they asked it, they don't want cash, they want Robux. So it was very interesting. So my 10-year-old nephew came, and so he asked for Robux. I said, okay, fine, you want it Robux. But then I gave him another question. If you want Robux, but you have to answer my question first. If I were to hypothetically give you $1 million, would you want it in Robux, where you can buy lots of things in your metaverse, in your gaming metaverse, or would you want that $1 million to be bought in a proper house, a proper condominium, real estate, real stuff? And you know what his answer to me was? He said, no, neither. I don't want $1 million. I'm not going to have a house. No, I'm going to have it in a Roblox metaverse. I would want it in Bitcoin. 10 years old. But that was his view back in Chinese New Year. Now with the crash of Bitcoin, probably his view has changed. So I think the metaverse is probably here to stay. It's evolving. And I think what we're going to see is perhaps one of the most permanent trends to us, and that's climate change. And as much as climate change is going to be accelerated, I believe that the uncertainty of the war has pushed ahead with the energy transition because of the need to diversify energy sources, the need for energy security. You're going to see huge amounts of investments into renewable energy, especially in Europe, but also across the world. And this is going to be a very powerful investment team in the years ahead, especially when it comes to energy transition. And of course, in a more disrupted world in which the world is going to be much more complex, disruptions from pandemic, war, digitization, supply bottlenecks, food shortages, climate change, you need companies that are very solid, unique quality companies, particularly to identify those more than just looking at financial matrices like profitability, debt ratios, etc., which is traditional. You have to look at those. You also want to find companies who are leaders in the environmental, social, and governance factors. That means companies that do well on these qualitative aspects as well, because these companies tend to be the leaders. If they do well on these scores, chances are they can navigate through these uncertainties much better than those that don't. Of course, a company that scores highly on ESG matrices are less likely to face environmental breaches. They are more likely to be able to adapt their supply chains to climate change. And of course, they will have a higher productivity in their workforce, happier employees, and of course, much stronger governance and leadership. And of course, the opportunity in sustainability is going to be huge. In order for the world to transform totally, to reconfigure into an economy that's net zero by 2050, you need at least $9 to $8 trillion being spent every year, every single year from now until 2050. That's equivalent to 7 to 8% of GDP. The world is not spending that yet, but once they realize the need for that transition and start spending, there's going to be immense opportunity in the sustainability revolution, which could manifest itself in energy transition, it could manifest itself in smart mobility, it could manifest itself in smart infrastructure, or even sustainable agriculture. So these are the themes that are coming out as a result of all these disruptions that we're going to see in the years ahead. And I think one theme that's related to sustainability is this idea of a circular economy, because very much so, the world economy right now is very much linear. It's a take, make, and then you dispose. And of course, with the rise in the world's population in the years ahead, you can expect that we're going to take much more from the earth, natural resources, energy, mines, stones, minerals, etc. We're going to make, and then people are going to throw away. So you're going to get landfills. So this whole linear model is not sustainable. It will destroy the planet. It will affect our biodiversity. And the solution is actually to make it, instead of linear, to make it circular. So instead of making and then you dispose it, what you do is you make it, you make sure you try to use resources judiciously, and in your manufacturing process, you build the product to last longer. And of course, whatever waste that you have in the whole manufacturing process is recycled back. And if you have and you close this whole loop and create a circular economy, we can actually preserve the diversity, biodiversity in this world, and perhaps even push ahead and accelerate the push towards net zero. And I think that's going to be a very powerful theme to consider for investors in the years ahead. So in terms of investment strategy right now, you have to think things and frame it up in terms of scenarios, because there's so many ways the world economy could pan out. Well, our base case is, of course, that the world economy is going to slow down but not have a recession. And of course, inflation to slowly peak out in September and start to moderate going to 2023. But of course, we could be wrong. There could be other scenarios. What if inflation rises even higher, 10, 15%? And that reaction, if it does happen, would mean that the central bank have to raise rates even more. Currently, we have the Federal Reserve raise rates last night. And if inflation does become 10, 15%, the central bank would have to increase rates even more. Currently, what the Fed says that they will do is to increase rates by the end of this year to about 3.25 to 3.5%. But if inflation doesn't fall and rise even higher, say 15%, they have to raise rates perhaps by 5, 6% this year. And if that happens, it will tip the world into a recession. So there could be a bad scenario that could happen. And of course, the strategy would have to change. But as much as you consider the bad scenario, you also have to think about the good scenario. What if inflation falls faster than most expect? What if growth slowly picks up? And what if China, in terms of its growth trajectory, becomes much stronger than what most people think? So there could be a growth positive scenario as well. So I think it's very important to frame things up in scenario. And I think one most important lesson, I think, for most investors is to actually have a diversified portfolio. Because you rather prepare rather than you predict what's going to happen. And the preparation to me is really about having a diversified portfolio. Everyone is different in terms of your risk tolerance, but on average, a moderate investor, as how I'll recommend, is roughly about a third in equities, global equities, a third in global bonds, and a third in alternatives that includes commodities, precious metals, real estate. And if you have such a portfolio, it's fairly resilient, and we have seen even past recessions to actually bounce back quite fast. And clearly, I think that the message really is that if for most people who are sitting on the sidelines, who have lots amount of cash, this is a time to actually start to be greedy when everyone is fearful, to start to have a disciplined plan to build your portfolio roughly according to such a diversified portfolio, and to kind of put in a certain amount over time to slowly build and allocate your portfolio such that you reach such an allocation. And once you have that, it allows you to kind of build wealth over the long term. And of course, once you have a diversified portfolio, you can consider about the longer-term themes such as energy transition, longer-term themes such as the sustainability revolution, and longer-term themes such as biodiversity and circular economy, which I think are going to look extremely interesting in the years ahead. So I think with that, I will pause my presentation here, and I will hand the time over to Anita, whom she would moderate a panel session with the rest of our speakers. With that, thank you very much for your attention. We're going to hear from you soon.
Thank you, James. That was a lot to unpack in terms of the important trends happening in an environment of heightened macro and market volatility. We are going to proceed with the panel discussion now. James, you've got your seat. Let us welcome Kee Wee, founder and principal economist of Waveney Economics. And Saurabh Dhingra, partner in Asean Financial Services Strategy Leader, EY-Parthenon. It's getting choppy out here. Before we begin, for online guests, if you have any questions regarding the discussion topic today, please find the link to the Q&A in the Zoom chat box. Let's jump straight in. It's getting choppy out here. A war, a pandemic that doesn't want to leave us, a continuing climate and ecological crisis, while the price of just about everything is rising. These have darkened global prospects significantly, and a recession is set to make its presence felt so soon again. If not this year, maybe next. It's likely that we haven't seen the worst of it, although there is hope. With a slowing economy, rates may not be raised as aggressively as feared. Well, we know about all those rate flags. Today's agenda is for our audience to better understand how to navigate this disrupted or rather upended world. But before that, I'd like the experts to share their thoughts on when, if a recession hits us, how deep could it be, how long could it last? Kee Wee, would you like to start the ball rolling on this?
Okay. Good evening, everyone. What James has just said is perfectly possible. Okay, the interest rates will continue to go up. Just that the question is how far it will go up. U.S. inflation is 9%. The current interest rate is 2.5. So theoretically, if you're supposed to control inflation, rates have to go up that high. But that will kill the global economy. So that is the danger. They cannot do that. And also because this inflation is different. It is, in a sense, caused by supply issues. If you can't get those things, you have to raise prices. How would rising interest rates actually help? Ideally, government should try to stimulate the supply side, but that is harder. But if we take that view, then I put the world into this maybe two categories. Europe will, I think, suffer for the next many months because they will suffer from shortage of gas and all that. Maybe Asia will pick up a bit because China is coming up. The US will be bogged down by inflation as well. So it will probably have a two-sector global economy. Okay, but that is the best scenario. The worst scenario, and I'm saying it not because I believe in it 100%, but I think it's possible, otherwise I wouldn't say it. The battle of Ukraine is ending. The battle of Taiwan is beginning. And if that happens, we'll have more turmoil in the next year or two. But it doesn't mean that there are no investment opportunities. There'll be lots. You know what I mean? During the pandemic, those who made gloves, those who make masks, made a lot of money, okay? And that is possibly. Why do I think that this battle of Taiwan will happen? There's only a short time gap for the US to work. Since the 1990s, they've always been want to be number one, okay? Now, given enough time, China's economy will grow. There's no doubt about it. So they must do something about it. So, and then BRICS, they're coming out with a reserve currency. That will undermine the US dollar. Again, US dollar down, US economy going to be number two. That is a no-no for the neocons running it. So I believe that they will do something within the next 1 to 5 years. That's the most pessimistic scenario. I hope it doesn't happen, but I think there's a great possibility. Over to you.
Saurabh?
Thanks, Kee Wee. Thanks for your views on the macroeconomy. I think my view is a little more positive, I would say. While obviously we are facing the inflationary and potentially recessionary pressures globally, starting with the US, but we have seen a little bit more stronger sort of a growth over the last few years, but few months, particularly in Asia, and I'm a lot more optimistic about Asia. Obviously, we'll have to continue seeing where the inflationary pressures are going, and therefore how the central banks in our Southeast Asia as well as the Asian economies will react to it. But if you see the last 2 or 3 quarters, there have been a lot of positive signs in terms of the growth, GDP growth, and particularly it's been driven by the domestic consumption, which is a very positive sign. And obviously in these environments, we need to, as James has presented, we need to think of different scenarios and therefore to decide on sort of what is our investment strategy going to be, how are we going to balance our risk and rewards, and sort of where do we put our money in. There are definitely new opportunities that will come with this disruption. I mean, clearly sustainability is one big area where we think globally the economy as well as the industry, both the public and private will come together and need to invest heavily into that space, which will create new opportunities for all of us. So yes, I think we are in this sort of inflationary stroke recessionary pressures over the next few months, but hopefully that's a matter of the next 2 to 3 quarters, and we are sort of to 2023, we start seeing the growth upward across the world.
James, I know you gave your glass half full perspective just now. Do you have anything more to add?
Well, I think for investors and people in the room here, I will leave some signposts for you to watch because it's hard to actually predict range of outcomes is large. But as I mentioned, look out for inflation trend, see when that's starting to plateau. Currently, it's on the way up. But all you don't need inflation to fall back to 2%. All you need is the leveling of inflation. So watch out for that. That would be a sign for stabilization in financial markets. And of course, what's key that's been driving financial markets is actually the repricing of interest rates. So if you do get a stabilization of inflation, the interest rate trajectory would also take care for itself. The next marker to watch or signal is actually the earnings season. So watch out for that. Currently, Q2 earnings season ongoing, mixed bag. Watch for Q3 as well. So there will be winners and losers in this space, but clearly the trend, generally speaking, is that analysts will cut their earnings and companies will guide their earnings downwards. So that was going to play out. And I think what you have to watch out for in financial markets is not so much in the fullness of the bad news. It's when you, at the margin, start seeing news getting not that bad. So that's something to watch out for. Could likely happen in Q3 or Q4, and that could actually kind of provide some recovery in markets.
I do want to revisit the point about the tightening trajectory of central banks. Some major central banks have been accused of being behind the curve when it comes to this, and hence the need to aggressively front-load the rate hikes, given the spiraling inflation. How are the Asian central bankers doing, the policymakers? Are they tightening appropriately, or should we expect more bitter medicine down the road? And do you think they can engineer soft landing, because Asia really is very much in the early stages of economic recovery? Anyone?
Well, I'll start first. Most central banks are behind, but that is expected. You see, when you take something away from somebody, you will be a bit more reluctant. And raising interest rates is like taking something from somebody. So all central banks will have to be cautious. So in the case of EU, UK, and US, the inflation is about 8-9%, and the interest rates are around 2% less. So they have a lot to catch up, provided they want to go up near 9%. For the Asian banks, Philippines, Thailand, Indonesia, they are also slightly behind, but their interest rates are about 2 to 3%, and their inflation about 6%. So they will have to catch up, but it's just that their growth is also quite good, because growth figures lag. And of course, even in the EU, the first quarter growth is still good. So it is very dangerous for the central banker to take away, raising interest rates like taking away from the people. They'll be more reluctant to do that. Singapore doesn't use interest rates, they use exchange rate. So our inflation is about 6.7, our overnight interest rate is about 1.6, so there's a 5% gap. So if we take the view that MAS want to close inflation using that 5% gap, then today's USD Sing dollar is 1.39, so we look at 1.32 if MAS sees the same view, 1.32. That's 5% from 1.38.
Thank you, Kee Wee. Well, we'll want to get straight to the point. While every crisis presents a chance to reframe reality and create new opportunities. For example, the pandemic led to hyper-digitalization of many industries, from healthcare, finance, communications, to consumer services. The world of e-commerce continues to be reshaped with further digitalization and emergence of new commerce models, including metaverse. How do you expect the gears to shift further on this digital transformation? Saurabh, I'm sure you'd like to take this one.
Yeah, I think you rightly pointed out, needless to say, last 2 years, we've seen significant acceleration of the digitization transformation, which probably started across the industries probably 3 to 4 years ago. It's still in early stages, I would say. There's a lot more to happen, and I hope this something which we started over the last 15 to 18 months will continue. We're going to continue seeing a lot more money being put into the digitization or the transformation of the companies. A lot of support from the governments to drive digitization of the economy as a whole. We have recently done a study, and we've seen the companies which were actually transformed themselves digitally have seen much higher returns in terms of 3 to 5x compared to the companies which we haven't. And there's a lot more opportunity to continue driving that transformation. With emergence of new technologies, we spoke about metaverse, we spoke about digital assets, we spoke about blockchain as the underlying technology, will create a lot more opportunities to drive this further.
So same thing, just stepped up a lot more.
Absolutely.
Essentially.
Absolutely, and we have seen the benefits of it over the last 15 months. And given we are in such a high inflationary environment, digitization will actually help the companies as well as the industry really manage the cost much more effectively. And therefore, we believe that this journey will continue.
What about you, James?
Well, if you take a step back to when digitization really became a game changer was when the iPhone was introduced back in 2007. So since then, everything became mobile, all on our mobile phones. And now, on average, everyone spends about 5 to 6 hours on their mobile phones. That's about the amount of time I sleep. But that's true, global average. I'm not saying anyone here, but just on average, 5 to 6 hours on your mobile phone. And my suspicion is that even if it's just two-dimensional, people spend so much time. If it becomes much more engaging, if you ignore that the interaction is going to be on a particular platform, if it becomes three-dimensional, for example, if it involves multi-sensory, plugged into the digital world, I think the number of hours is going to increase. So I think that trend towards metaverse relies a confluence of technology, blockchain. You need software to be much more engaging in terms of digital content creation. You need 5G, you need cloud computing, Internet of Things. And we sort of have all these convergence of technology right now. It's bring it together. And I think that there is a chance that in the years ahead, that metaverse could be also that disruptor like what we've seen back in 2007. And I think that's a space that investors should actually think about and seriously put on your radar and look at it in the years ahead.
Thank you. I want you all to hold on to a similar thought, forward-looking thought as well, in terms of what are the other significant medium and long-term trends we expect the perfect storm to throw at us, be it in perspective of managing the economy or interest rates. After all, there was a time when markets thought easy money was going to last forever. Or in terms of building a more resilient, regionalized supply chain, one that's less reliant on China, or even in the area of cybersecurity. Kee Wee?
Medium to long term. Well, I take that view that Russia has turned away from Europe. It's looking into Asia and Middle East. And so those places are going to be happening for many years to come. Europe, I think, will suffer for a while, but it will recover like all societies do. Right now, the green agenda isn't going to work because they have to resort back to coal and nuclear. But in time to come, I'm sure it'll be vibrant again. So in the medium term, I'll look at Asia, long term maybe also to Asia and Europe.
Well, for me, I'll place attention on Southeast Asia. Why do I say that? Because for many watchers of Southeast Asia, I've been a long-time watcher of Southeast Asia for the region. And if you watch it long enough, it sometimes feels like a movie moving in slow motion. It does go to the right direction. And I think there is historical facts to back that up. If you compare back in 2000, almost 20 years ago, trade between Southeast Asia and China is only about 40 billion. Right now, it's 850 billion. 20 times increase over 20 years. That's huge. And if you look at back in 2000 again, the size of Southeast Asia's economy vis-a-vis that of Japan, for example. Japan at the time is 8 times larger than Southeast Asia. Right now, we have caught up. Southeast Asia is around Japan's around 1.5 times bigger than Southeast Asia. And I'm sure in the next 10 years, or even less, Southeast Asia is going to be larger than Japan. So I think it's very important for businessmen, investors, not to ignore Southeast Asia because the growth trajectory is very clear. It has a huge population, rising income, and I think these are the components that is very solid. It will set the solid foundation for the growth of Southeast Asia in the years ahead.
Maybe I can add on top of what James mentioned. I mean, Southeast Asia economy, as James mentioned, we've seen that trajectory. And in fact, you spoke about the supply chain issues that the world is facing. And Southeast Asia is actually one of the gainers from that. I mean, we've seen a lot of investment going into Vietnam and some of the other markets in the region. And therefore, I think there is a lot more resilience. And it's been now domestically driven GDP. So therefore, I think a huge opportunity exists in front of us in Southeast Asia. And sustainability will actually create a lot more opportunities too.
You know, this is a great time to maybe expand on the sweet spot that is Southeast Asia. Global, in terms of minerals, global demand for critical minerals and clean energy technologies is set to grow rapidly, providing a big opportunity for Southeast Asia to make the most of its large mineral resources. Indonesia has nickel, Thailand has a booming automotive sector, Singapore has its chip sector. Could we see a time when the region turns into a manufacturing hub in this whole sustainability revolution? And which countries do you think are at the forefront of these transformations? Saurabh?
Yeah, I mean, you rightly pointed out a couple of specific minerals. I mean, Indonesia, definitely nickel is and what's happening in Russia creates a lot more opportunity for us, for this region. I'll also talk about sustainability, geothermal energy. I mean, Indonesia and Philippines are the second and third largest markets after US. And therefore, we expect a lot more investment to go in that. And we've seen a lot of capability being built up. Similarly, solar, I mean, Vietnam is investing heavily into solar energy. We've seen sort of a 10 gigawatt of sort of capacity were built over last few months and years, and therefore a lot more to come for Southeast Asia. The other areas I would think about is also the wind energy, where given our long shoreline, therefore it creates opportunity also for the wind energy. So the alternative energy sources, I think Southeast Asia can play a leading role from sort of what the global economy needs from this transition perspective.
James, any thoughts to add?
Well, I think Southeast Asia is interesting because this year is the Regional Comprehensive Economic Partnership, the largest free trade agreement is implemented, and Southeast Asia is at the heart of it. So that ties the entire Southeast Asia together through trade and investments. So you have Singapore, Malaysia with its electronic chip manufacturing capabilities. You have Indonesia with its nickel and natural resources. You have Thailand with its automotive industry that's extremely strong. And through that free trade agreement, if you tie them all up together, we have one big region that could potentially become and ride the whole sustainability revolution, and also become the manufacturing hub of the future that's built on AI, automation. And of course, the destination as a whole is going to be very interesting for multinational companies who want to diversify operations out of certain regions to be closer to their customers. And clearly, Southeast Asia, 650 million consumers. You have a 3.2 trillion economy, and we sit at the crossroads of $3.4 trillion of trade. So I think that's going to be extremely attractive to multinationals, a very good proposition for investors in the years ahead.
So talking about sustainability and energy transition, the prices of fuel from oil, gas to coal have skyrocketed as a result of the Russia-Ukraine war and worsening tight market conditions owing to Western sanctions. You'd know this if you looked at your electricity bills in recent months, or you've been filling up the tank for your car on the rising costs. The resultant energy crunch is also challenging nations' commitments to provide clean, secure, and affordable energy. How could this hurt the complex energy green transition in Southeast Asia? Do you foresee a slowing economy and rising rates to choke the much-needed renewables funding and pose more hurdles in the region's energy and sustainable development goals? I'm going to leave it open for anyone.
Maybe I can start with that. I mean, as I mentioned, there's a lot of investment that's already gone in sort of building renewable capability across Southeast Asia. And hopefully that journey continues, obviously, let's see how the macroeconomy plays out over the next few months. But given the commitments that have been made by globally as well as each country, even in Southeast Asia, we expect the journey has to continue, and especially with the growing oil prices, I think that is the long-term solution that the economies have to look at. I mean, I buy Kee Wee's point that let's see how things play out, and therefore the sustainability investment might have to slow. But I'm still very positive of the investment that has to continue happen, and we will see a lot more actually the private and public partnerships here, where the industry will come together along with the government, enabling it, and therefore driving the further growth in the sustainability investments.
But what could set back the agenda? What do you think could throw a spanner in the works that we should pay attention to, which we're not, while we draw a rosy picture for it?
Well, the current oil price is a reflection of supply and demand imbalances. But to me, it's just a short-term aberration. We are already seeing oil price starting to stall off. The trend towards energy transition from one that's largely fossil fuel into one that's renewable energy is an enduring trend. It's a long-term trend. There will be kind of bumps along the way, but that trend is clear. Well, higher oil price is a speed bump, but it will not derail that whole transition. In fact, in some areas, it's going to accelerate the transition because of the price differences. So I think that with huge amounts of investments going into renewables, it will reduce its cost, as we've seen how battery prices have fallen significantly over the last 10 years. And I think wind, solar are all extremely ripe for that sort of economics of scale that's going to occur. And of course, Southeast Asia, with its huge amounts of land mass, is very conducive for such technology. In addition, you still can have hydropower, etc. So Southeast Asia is also at the cusp of this green energy transition. And if we were to, as a region, start to reconfigure our economy to one that's greener and that has, which fits the net zero commitment, it can actually potentially generate $1 trillion of economic opportunity a year for investors. And I think that opportunity is great. It's not just manifested in energy transition. It's in smarter and more sustainable infrastructure. It's in the electrification of transportation system. It's also in much more sustainable agriculture.
I want to jump right in, since we're running a little low on time. Billionaire Warren Buffett said, "Be fearful when others are greedy. Be greedy when others are fearful." Fear reigns in markets today, and bearing in mind that none of you can provide views such as recommendations, what do you think investors should be cognizant of when investing in this volatile climate? Any guiding principles as such? Kee Wee?
Well, obviously I'm a bit more pessimistic. I would say that we are going to face many more months of chaos and volatility. For myself, I'll be ultra conservative, but it is important, because we can never be right, okay, I would put a lot of my money to James because he looks at 4 screens every day. He doesn't sleep. I do sleep. So I'll pass it to him. They are the professionals. They look, I don't want. Every morning I'll go to my Qigong and I don't care.
Well, I have a big team, so I've not just 4 screens, I have a big team helping and mobiles to monitor Twitter and social media accounts as well. But it's ultimately, I think, we are here at HSBC to serve everyone's financial needs. So you have the quote from Warren Buffett, be greedy when everyone's fearful and be fearful when everyone's greedy. I have a few quotes, probably 2 or 3 more to add. One is the biggest risk is not taking any risk at all. I think that's very important because I believe most investors or most people here, in fact, if you do a survey, you actually hold too much cash. That's inaction, that's sitting on the sidelines. And in fact, now, this time, and I'm sure in the next few months, would give you a very opportune time to start thinking about investments. And of course, you don't want to take speculative bets. You want an entirely diversified portfolio. And I think that's something to think about. Another quote I will leave is probably, don't try to predict too hard the future, but be prepared for it. And I think preparing really is about having a diversified portfolio, and we are here to help you with that journey. And perhaps my last quote is to think long term. And I think what's clear is that it's not timing the market that's important, it's having time in the market that's much more important. Let the power of compounding interest in a diversified portfolio help you build your wealth over the course of your lifetime. And I think it's not one time buying that portfolio, it's almost kind of setting aside a certain amount of savings each month and put that amount of savings that you're comfortable with to that portfolio and let it grow over time. And I think that strategy and that discipline can tide you through whatever disrupted or volatile market conditions that usually are just short-lived.
Sounds sensible enough and lovely quotes to help us in this climate. Saurabh, you sounded like you had something to add?
Since we're on the quotes, I'll add a quote too, right? I mean, Winston Churchill said, right, don't let a good crisis go away. So I think look at your long-term strategies. Look at the opportunities that you wanted to invest. Given the current connection, actually creates an opportunity for you to enter some of the markets or the places where you thematically believe in it, right? So take that opportunity and play that plunge. Obviously, take a very diversified view of the portfolio. As James said, I mean, nothing like we will get over this, even if there's challenges over the coming few months. But if you take a long-term view and pick your bets, I think this is a great opportunity.
Thank you. We'll now be answering some questions that have been submitted and try our best to answer all of the questions. As a gentle reminder, the speakers are not able to offer any sort of product recommendation and predictions. The tech and social media sector is seeing a major sell-off in global financial markets, despite the fact that disruptive tech businesses are here to stay, and we've heard all of you say that today. Is this being triggered by high valuations, or could investors be losing faith in certain business models in this space? If yes, then where will the access to funding come for these pivotal businesses?
I think, I mean, you rightly said, I mean, the valuations have definitely corrected significantly for the tech businesses. But having said that, the investors still believe in the right business models. I think it's an opportunity for the frenzy to stop, right? There was huge frenzy in terms of going into tech over the last, 15 months or 12 months. And so the business models which have a long-term value creation will survive. And therefore, it becomes a lot more important from the micro perspective that you look at which company or the business model you believe in and go after that. And we know that the private equity players are definitely looking at this place very closely. I mean, we're doing a lot of work in this space and working with quite a few private equity investors who continue to sort of evaluate this place. And believe me, the good assets are still not really at the valuation which we would like it to be. So there is definitely opportunity in the tech sector, especially in some of our markets we are present in.
Anyone else?
Well, I think what we have experienced in financial markets clearly in the first half of this year is a repricing of interest rates. And clearly, all financial assets are discounted of future cash flow by interest rates to the present value. So if you have interest rates increase, all financial assets will get affected. So bonds get affected, especially long duration assets. And also, of course, you have tech sector, which is also considered a long duration assets. As interest rates rise, the tech sector got sold off indiscriminately. But I would say that not all tech companies are created equal. Some will be the winners, some will be the losers despite of this. So I think it's very important to be extremely selective, to look at the tech companies that score well, perhaps on ESG scores that are geared towards some of the big structural trends that we talked about that could, whether it's digital revolution, sustainability revolution, how are they playing a role in all of these? And perhaps those in the metaverse. And I think if you have those kind of frameworks in mind, it can help you better select companies in that space from a kind of macro point of view, but also from a micro company perspective.
Thank you. We've got a question on the recent US Federal Reserve rate hike, 75 basis points last evening, and Powell's commentary as well. What are your views on the US economy having a soft landing?
Well, I'll take that question. Well, we have 75 basis point increase. It's fairly large, and the tightening cycle is very steep by historical standards. But also what is clear is that currently interest rates are around 2.25 to 2.5%. We are already more than halfway the hiking cycle as what the Federal Reserve says they would do by the end of this year to about 3.25 to 3.5%. And I think now where markets are looking out for is, and it's not so much on how much the increase will be from here, because largely the increase is already priced in. Now where market participants are looking out for is when the Federal Reserve will pause and start to cut interest rates. And that's what we are calling the Fed pivot. I think it's still too early for that Fed pivot to occur because, of course, if growth slows down, the Federal Reserve can't just keep increasing interest rates. They have to start to think about when to pause. So it's still too early to expect a pivot to occur for the Federal Reserve. But I think as we enter into year end or even to early next year, potentially that could be a time where the interest rate pause could happen. And once that happens, of course, it ties with the fact, and it does have to happen when the inflation outlook stabilizes in the United States. So these are the signals that I'm watching out for. If we do get a plateauing of interest rates, perhaps sometime down the road towards the end of this year, if we do get a plateauing of inflation September or so or October, then perhaps we can have some kind of relief in risk assets.
Kee Wee?
Well, I think the rates will go up more than that. I think they have to probably go to 7, 8, or even more, depending on inflation figures. Right now it's 9.1. It might come down. Then everything, like James has said, no, it might stop at 3, 4. But I don't think so. I think it'll go up, kind of fall right up to maybe in mid-year next year. Yeah. But,
don't hold yourself back on the gloomy outlook, Kee Wee.
Yeah, I know. But then we are in a bad patch as well. We haven't seen the end of the tunnel yet. Yeah.
So you don't believe that there could be a soft landing for the U.S. economy? Is that what you're saying?
See, both ways they are fixed. If they raise interest rates, they kill themselves. If they don't raise interest rates, inflation will continue to rise. So they are in a very difficult position, very difficult. I don't know what they're going to do. But both ways, they're fixed. Yeah.
Fair enough. We've got a question on your views on commodities and related currencies, the Australian dollar, Canadian dollar, in light of the impending recession. Is this something anyone wants to shed some light on?
Yeah, well, I think in terms of Aussie dollar, Kiwi, commodity currencies, we have a neutral call on it. Really because of the leveling of commodity prices, we are seeing early signs of that. Even wheat prices have fallen 40% from its peak, and every other commodity as well. It's still at a very high price, but it's starting to level off. And I think that would feed through to some of the commodity currencies. And also, a lot of these commodity currencies are also what we call risk-on currencies, which means that when markets go up, these commodity currencies will go up, but when markets go down or are volatile, they go down as well. So we think that the outlook, at least for the next 2 to 3 months, is going to be extremely volatile because the inflation outlook is not clear. The next few inflation reading is likely to be high and volatile, and that trajectory of what the Federal Reserve will do is still not clear. So from that perspective, we want to be a bit careful with Aussie dollar. I mean, we have a neutral call or related commodity currencies, really because we think it's likely to be volatile and perhaps sideways from here.
I mean, we know what we need to look out for, whether on inflation data to determine what the tightening trajectory is going to be. But does anyone dare warrant a guess on when you think inflation's going to ease? Or has it already peaked? And if it hasn't, when would it?
I gave my month already.
You
Do you want me to give you the date, the day and the time?
Nobody knows the peak, actually. That's why you have to be, well, I will be careful with what I have, and whatever I allocate to James, he will have to look at his 4 screens every second of the day. It's just that it's very difficult. You look at how the cryptocurrency fall. You wake up and it's gone. I mean, it could happen. So just be conservative. I would be anyway. Yeah.
Thank you. I know I put all of you on the spot.
I weren't there.
One issue that continues to plague the world is the disruption of supply chains led by the pandemic. We covered that a little bit. The war in Eastern Europe and China's zero COVID policy. How do you see the current challenges reshaping the regionalization or rather the integration of supply chains in ASEAN towards building a more resilient system? And what could the opportunities be on this front?
Maybe I can take that question. Look, I think what we have seen is definitely a lot more onshoring or nearshoring as an outcome of COVID and now the war, and therefore one is the diversification away from China or the Greater China, and therefore Southeast Asia has gained from this challenge or the crisis. Also, as I mentioned, onshoring or nearshoring has created a lot more manufacturing capability and an opportunity for the markets we are present in Southeast Asia. And this will continue. I think there will be a lot more, we will continue to see this nationalism or localization or the onshoring of the manufacturing, given what we are seeing in the broader supply chain. And hopefully the China start opening up and start solving that in the coming months, which will ease out the supply problem. But the trend will definitely continue to see in the coming months.
Mm-hmm. I've got one question for any one of you to answer from the audience. Do you foresee electric cars being a mainstream purchase as prices fall and they become more affordable? This cannot be a Singapore resident. Anyone?
Well, I think it will drop in price in non-Singapore areas.
There you go.
I mean, the electric vehicle is actually, to me, driven by China. China doesn't want to depend too much on oil, so it has to develop alternatives, pushing for EV. So, and they are pushing it very rapidly, and of course, in time to come, not in Singapore, but prices will drop everywhere. Yeah. And all this supply chain that we are seeing now is the disruption in the war after the sanctions. Nord Stream 1, Nord Stream 2 is not going to happen anymore. They are building pipelines to India, to China. This will be your new supply chain. Yeah.
Thank you.
Yeah.
Closing question to what has been quite a dynamic conversation. What is your take on how we're going to wrap up what's left of the year? We began on a more optimistic note. indicators were healthy, corporate earnings, consumer spending, economic activity were all on the up and up. Now all these indicators have softened as the narrative has soured. How are we going to end the year? And because I'd like us to end our session on a hopeful note as well, what are the bright spots that deserve our attention as we shift our focus to 2023?
Maybe I can go
We can
first.
start with Saurabh and you.
Yeah. So look, I think the next few months are going to be choppy and volatile, as we discussed, given the inflationary pressure. But hopefully, some of the optimists here believe that the next this will be a couple of quarters, and as we enter 2023, we will be back onto the growth trajectory across the group. Definitely, there are a few themes as we discussed. Sustainability, for example, is one. Digital or digital transformation, and especially picking some of the right business models would be a great opportunity as well. So there is light beyond the tunnel. Obviously, next few months will be quite volatile, and therefore to be watchful for.
Well, even though I'm pessimistic, I'm optimistic because the human being is very adaptive. Remember when SARS first hit, we got stuck, we couldn't go out, we couldn't do a lot of things. But after a few months, we get used to it. Oh, Zoom is actually better than going for meetings. You know what I mean? And so even the next few months, I see a lot of volatility and all that. We will get used to it. We'll get used to it.
Kee Wee, you mentioned SARS.
Sorry, COVID. Which is the second version of SARS.
Well, it's hard to, there's lots of noise that is going to happen with data next few months. But if you remove all the noise, to me, one trend really stands out. And I think that's sustainability revolution. You have to embrace it as an opportunity. You have to think about it as how you construct your investment portfolio. It's going to be one of the, well, as much as climate change is going to be our biggest threat, it's also going to become one of our biggest opportunity. And I think you have to place sustainability at the heart of your investment process and thinking clearly in the years ahead.
Should we write off 2022 altogether, or is there still hope for things to turn around at this point? We're nearly in August. So, and then as we step foot into the fourth quarter, I'm wondering, should we give 2022 a chance to turn around? Or should we, in terms of market outlook and macro outlook, or should we just write it off and look forward to 2023?
Well, it depends which position you're from. If you have lots of cash now, or largely your portfolio is in cash, this is a time not to write off. This is a time to, be extremely excited.
Gung-ho.
Yeah, correct. And of course, you don't go all out. You kind of phase it out because the outlook is going to be fairly uncertain. But nevertheless, I think there are certain kind of support or bright spots. For example, certain economies, the US is still actually fairly robust if you think about it. Consumers are still strong. Southeast Asia, a place to look out for. We've mentioned the strong structural growth opportunities. So never ever, every day counts. Never ever write off the entire a year. Always think of how each day plays out, where the opportunities are. How do I rebalance my portfolio? There is a lot of teams that are building out, and clearly we've identified many, many interesting teams for investors to consider in the years ahead.
I want to bring up one of the audience questions since we're still talking about it. In terms of China, Chinese equities, the stock market has been resilient throughout, and there's value emerging from that as well. Still, what are your thoughts on that?
Well, we currently have a neutral call on China right now. China has its own issues, for example, but there are some support. For instance, policy divergence. The rest of the world is tightening policy. China is actually cutting interest rates, loosening monetary policy. That would actually provide some support. But I think it's still too early to go all out. There's still an issue with the property market. In fact, of course, COVID policy is still very uncertain. But nevertheless, I think for investors who have long 2 or 3 years horizon, if you look at valuation-wise, it's actually quite attractive vis-a-vis its own history and vis-a-vis other markets. So I think it's worth considering from a portfolio perspective that one should always have an allocation to China, given that China is going to be a very powerful and strong economy in the years ahead.
Right now, there's a lot of disturbance in the financial market, also because it's not just a tax add-on, it's because of the sanctions on Russians. Now, if you're Chinese and your investments in US, you want to take it out. If you're American and you have investment in China, you want to take it out. So all this is happening now. Nobody wants to buy certain countries' assets because they're afraid that it'll be sanctioned. So of course, if we all believe that Asia is the future, then all the tech stocks or whatever will try to be listed in this Powerball, and that will be good. And there are opportunities.
Any thoughts to add, Saurabh, on China and maybe as far as the tech sector is concerned? And
yeah, I think if I would agree with James' view of if you take a long-term view of there are definitely a good opportunity to even sort of enter some of the Chinese stocks, not necessarily go all out, but definitely there is a lot more resilience if you take a long-term view. And China will continue to play a very, very critical role in driving that innovation, especially around the technology. And we have seen over the last 5-7 years what Chinese economy has been able to push really the thinking as well as the whole digital evolution, which sort of now West or the rest of the world is actually following. So I'm still very positive in a long-term view from the technology perspective.
Mm-hmm. Thank you, gentlemen. With that, we've come to an end of tonight's discussion. Thanks for sharing your thoughts, expectations, gloomy and bright outlooks with us. For our online guests, we hope you've enjoyed this fruitful exchange, and we hope to see you again soon. It's the end of it soon. Thank you so much. You can enjoy your dessert right now.
Thank you. Thank you.
Thank you, Anita.
Thanks, Kee Wee. Yes, you're an afterwards. Thank you, John.